The hidden machine running in real time. Watch this number, $2 trillion. That's how much China processed through their digital yuan, e-CNY, in a single day this September 2025. Not through Visa, not through your bank, through a system that doesn't need America's permission to exist. While you were scrolling TikTok, distracted by entertainment and daily news, China just activated the infrastructure that ends dollar dominance. And here's what nobody's telling you. This isn't new. This isn't unexpected. This exact pattern has destroyed every reserve currency in history for the past 500 years. I can prove it to you in the next 25 minutes with 4 historical examples that will fundamentally change how you view global finance and your personal wealth. Once you see the pattern, the present becomes undeniable. This isn't opinion or political commentary. This is mathematics applied to historical cycles that never fail. Part 1. The current state, the numbers that matter. America's dollar dominance, declining measurably. Right now, as you read this, the United States dollar controls 56.32% of global foreign exchange reserves as of Q2 2025, according to the International Monetary Fund's latest currency composition of official foreign exchange reserves, COFR survey. That might sound strong until you understand the trajectory. In 2001, the dollar represented over 73% of global reserves, just 24 years ago. Today, 56.32%. The decline isn't random or temporary. The United States is losing almost 0.7 percentage points of reserve share annually. At this rate, dollar dominance below 50% occurs before 2035, a mathematical certainty if current trends persist. But here's the part that should concern every American. China's digital yuan isn't theoretical anymore. It's operational. It's scaling. It's already bypassing the dollar for trillions of dollars in transactions. China's digital yuan, the alternative system, is live. According to the People's Bank of China's most recent report, October 2025, digital yuan payment volumes have nearly doubled in just 14 months, reaching RMB 14.2 trillion, approximately $2 trillion USD, through September 2025. Up from RMB 7.3 trillion in July 2024. More concerning than the transaction volume is the infrastructure scaling. 2.25 billion digital yuan wallets now exist, up from 180 million in July 2024. 23 central banks directly connected to China's digital payment system. Transactions settle in 7 seconds versus days for traditional banking. 98% lower transaction costs compared to traditional cross-border transfers. Project mBridge now includes China, Hong Kong, Thailand, UAE, and Saudi Arabia, with instant cross-border settlement capability. While America debates internal politics, the infrastructure for the post-dollar world is being built in real time in Shanghai and Beijing. The petrodollar is already broken. For nearly 50 years, one simple fact underpinned dollar dominance. Oil was priced and traded exclusively in US dollars. This petrodollar system meant every nation needing oil needed dollars. This created permanent demand. This demand created reserve status. That system is now broken. Saudi Arabia joined Project mBridge in June 2024 and began accepting yuan for oil purchases from China. Malaysia, Thailand, and UAE are settling an increasing percentage of bilateral trade in local currencies. BRICS member states are actively shifting trade settlements to local currencies. RMB now accounts for 50% of intra-BRICS transactions in 2025. India is purchasing Russian oil in rupees instead of dollars. Egypt announced in July 2025 it has stopped trading in dollars for bilateral BRICS transactions. The erosion of the petrodollar isn't happening in the future. It's happening now, in 2025. documented through official government announcements and settlement data. America's debt, the ticking bomb. $40 trillion. That's the United States national debt as of December 3, 2025, according to the Joint Economic Committee's monthly debt update. Per person in America, this translates to $112,081 per citizen in personal national debt. Per household, $284,914. But the most terrifying metric isn't the total debt. It's the interest payments, $981 billion in net interest payments over the preceding 12 months, October 2025. This is 13% of every dollar the government spends, third largest line item after Social Security and Medicare. Interest payments have nearly tripled over the last 5 years. Average interest rate on marketable debt, 3.382%, and rising 50% of all U.S. debt matures by 2026 and must be refinanced at whatever interest rates exist then. If rates rise even 1%, that's another $380 billion in annual interest expenses forever. The government cannot cut its way out. It cannot tax its way out. The only option left is to keep printing money, the same choice every failing reserve currency has made before its collapse. Part 2. The 5-stage pattern. Immutable law of reserve currency collapse. Every reserve currency in history has followed an identical 5-stage sequence. No exceptions. Spain, Holland, Britain, America. The pattern is as mathematically predictable as gravity. It runs on human nature and mathematics, both constants. Stage 1. Foundation. Real wealth creates credibility. A nation rises to power through genuine economic strength, not paper promises. Real production. Trade surpluses. Accumulated hard assets, historically gold or silver. Military strength capable of protecting commerce. Other nations want the currency because it represents actual value, not promises. Example, British pound, 1850-1900. Britain in 1850 was the world's manufacturing powerhouse. The Industrial Revolution began there. Britain exported manufactured goods, imported raw materials, real trade surpluses, real wealth creation. The pound became the global reserve because it represented genuine economic dominance, not manipulation. Example, American dollar, 1945-1971. After World War II, America emerged as the only major economic power with intact infrastructure. America had trade surpluses, massive gold reserves, over 21,000 metric tons, real production capacity, and unmatched military dominance. Other nations wanted dollars because dollars represented real wealth, the backing of America's entire productive economy and physical gold reserves. Stage 2. Ascendancy. Reserve status becomes privilege. Through war, through trade dominance, through international agreement, the currency becomes the world's reserve. Other countries hold it. Commodities are priced in it. Debts are settled in it. This creates what economists call exorbitant privilege. The reserve nation can print money and export the inflation to other countries, borrow at interest rates that would destroy any other economy, run deficits forever, with fewer consequences than non-reserve nations, finance military bases across the world at costs other countries cannot afford. For a time, this works beautifully. The world grows, trade expands, everyone benefits from stable currency and clear pricing. But here's the trap hidden inside this privilege. The power to print the world's money becomes irresistible. Stage 3. Overextension. When printing becomes policy, not emergency. Once a nation can print the world's money, stopping becomes politically impossible. Military spending explodes. Social programs balloon. Wars are funded through deficit spending. The government borrows not for genuine emergencies, but as permanent policy, Here's the mechanism that makes this inevitable. The reserve currency nation must run persistent trade deficits. Think about this carefully. If the world needs dollars for trade, America must supply those dollars. The only way to supply dollars is to have more imports than exports. Other countries can't buy dollars otherwise. Year after year, decade after decade, the trade deficit becomes structural. To finance the deficit, the government borrows. To service the borrowing, the government prints. The money supply grows faster than real economic output. Purchasing power erodes slowly. 1% inflation, 2%. The trajectory is locked in. America entered stage 3 around 2001 when the budget went from surplus to permanent deficit. 2 decades of wars in Iraq and Afghanistan. Multi-trillion-dollar financial crisis bailouts, COVID stimulus spending, trillions more for social programs. Each crisis brought more printing, more borrowing, more deficit spending. From 2001 to 2025, debt increased from $5.7 trillion to $38.4 trillion, 573% increase. Debt as percentage of GDP increased from 32% to 120.9%. Federal Reserve balance sheet exploded from $900 billion to nearly $7.4 trillion. Money supply growth has repeatedly outpaced economic growth. This is stage 3. Inevitable, predictable. Every reserve currency before America followed this identical path. Stage 4. Crisis, when reality catches up to mathematics. Eventually, the mathematics catch up. Foreign holders realize they're holding depreciating assets, melting ice cubes in currency terms. They diversify slowly. A central bank adds gold. A country settles bilateral trade in local currency. Another diversifies into euros or yen. The reserve share starts declining. This creates a feedback loop. As confidence drops, more holders exit. As more exit, confidence drops faster. The reserve nation can't stop printing because the entire system is built on monetary expansion. Inflation accelerates. The government intervenes with increasingly desperate policy. None of it works because the problem is mathematical. Too many currency units chasing too little real value. America entered stage 4 around 2020 when the dollar's reserve share began accelerating downward. The Federal Reserve began printing money at unprecedented rates. Inflation exceeded 9% in 2022, highest in 40 years. Central banks worldwide began diversifying away from dollars into gold. The evidence is overwhelming and current as of December 2025. Dollar reserve share, 73% in 2001, 56.32% in 2025, down 16.68 percentage points in 24 years. Central bank gold purchases, 254 tons year-to-date through October 2025, with 53 tons in October alone. Alternative payment systems operational. mBridge, e-CNY, SWIFT alternatives, all expanding bilateral trade, bypassing dollars. BRICS nations, Middle Eastern countries, Southeast Asian nations, all increasing local currency settlement. This is stage 4 in real time, the crisis phase. Foreign holders are exiting dollars methodically. Alternative systems are scaling. This isn't speculation or opinion. This is documented institutional action. Stage 5. Transformation. Market forces, not decrees. End reserve status. The old reserve currency doesn't lose status through war or decree. It loses status through market forces. Countries find alternatives. Bilateral trade bypasses the old currency. A new currency emerges backed by the nation with the strongest trade surplus and the will to maintain sound money. This is precisely what's happening now in 2025. Project mBridge is building the settlement infrastructure for the post-dollar world. China's digital Yuan is processing $2 trillion in transactions. Alternative payment systems, CIPS, Russian SPFS, are becoming operational. Central banks are accumulating gold at the fastest rate in decades. BRICS nations are actively coordinating local currency settlements. We are not in the future, we are in stage 5. Early stage, but undeniably unfolding. Part 3. Addressing the 4 objections. Objection 1. American exceptionalism. We're different. This is exactly what every dying reserve currency said. Britain believed the pound was eternal. The sun never sets. Royal Navy rules. London controls finance. Then World Wars I and II bankrupted the empire. By 1944, Britain was finished. Spain believed Spanish power was unshakable. The Dutch believed the guilder was irreplaceable. Rome believed the denarius would hold forever. Military power doesn't protect against mathematics. When a currency loses purchasing power faster than alternatives, markets adjust. American exceptionalism is mythology. The pattern is reality. No empire escapes this cycle. None. Objection 2. Technology and innovation will save us. Technology is real. American innovation is real. But technology doesn't change debt compounding mathematics. Rome had advanced aqueducts. The Maya had sophisticated astronomy. The British had the Industrial Revolution. Technology didn't stop their reserve currencies from failing. If technology could prevent reserve currency failure, Rome would still have the denarius. It doesn't. The Byzantine Empire replaced Rome not through superior technology, but through monetary discipline and real trade surpluses. U.S. debt grows 4 to 6% annually. The economy grows 2 to 3%. This gap compounds every year. Innovation would need to generate sustained 5 to 7% real GDP growth to outrun debt. America hasn't achieved this since the 1990s. Demographics are deteriorating. Workforce participation is declining. Productivity growth is anemic. Technology doesn't solve fiscal insolvency. It only accelerates debasement mechanisms. Objection 3. The government will intervene and fix it. The government is intervening. That is the problem. Every intervention since 1971 has been monetary expansion. The Federal Reserve's entire toolkit is lower rates, quantitative easing, lending facilities. Each crisis brings more aggressive action. 2001 recession, rates cut to 1%. 2008 financial crisis, rates to 0%, $4 trillion balance sheet expansion, 2020. COVID, negative real rates, $5 trillion additional monetary expansion. The interventions don't solve unsustainable debt. They delay reckoning and make it worse. Diocletian intervened with price controls in 301 AD, failed catastrophically. Nixon intervened with wage price freezes in 1971, failed in 90 days. Every country that tried printing out of debt without structural reform failed. No exceptions. When policymakers run out of options, they accelerate the inevitable. Objection 4. This time is different because of digital currency. No, this time is not different. Digital currency changes the mechanism of debasement, not the outcome. Yes, technology is different. Central bank digital currencies are real. They don't create real wealth. They don't reverse debt accumulation. They don't fix debt to GDP ratios. Digital currency makes transactions faster, makes surveillance easier, makes direct monetary control possible. Doesn't change that $38.4 trillion divided among 335 million Americans still equals $112,881 per person in national debt. If anything, digital currency accelerates debasement. No printing presses needed. Just change database numbers. CBDCs give governments perfect instruments to impose negative rates and capital controls. That's not progress. It's accelerated control and faster monetary destruction. The pattern doesn't change because technology changes. Pattern changes only when fiscal and monetary discipline changes. Nobody's proposing that. Part 4. What this means for you. 3 critical actions. Action 1. Understand the trap you're in. The machine runs on incentives. Reserve status is blessing and curse, gives ability to print out of short-term problems, guarantees long-term destruction because printing incentive becomes overwhelming. Every politician wants more spending. Every constituency demands benefits. Every lobby pushes for subsidies. The reserve currency is treated as a magic money machine, until it isn't. Understanding this means recognizing that no amount of intelligence or good intentions from policymakers stops this cycle. They're trapped. The machine has one gear, forward toward debasement, toward crisis, toward transformation. Action 2. Position outside the system. Dollar debasement means holding dollars is holding melting ice. Every year, purchasing power declines. Official inflation understates reality. Shelter, food, energy, education, healthcare rising faster than CPI shows. If you're in dollars, you're on a conveyor belt towards slowly becoming poorer. Assets maintaining purchasing power become essential. Hard assets, gold, silver, things that can't be printed. Real estate with positive cash flow, intrinsic utility, income generation. Productive businesses, pricing power to pass inflation to consumers, equity in diversified income streams, not dependent on single employer. These don't guarantee returns, but provide protection against debasement. Action 3. Reduce dollar debt, especially variable rate. In a currency crisis, interest rates spike unpredictably. Fixed rate debt becomes manageable. Variable rate debt destroys you. If you have variable rate debt, refinance to fixed rates before rates spike. Every percentage point increase in rates on $1 trillion of variable debt costs $10 billion more annually, forever. Reduce leverage before crisis forces you. The higher the rates go, the more likely systemic instability becomes. Action 4. Build skills and networks that survive transition. Currency changes destroy paper wealth. They don't destroy competence. Develop skills remaining valuable regardless of currency regime. Learn repair, maintenance, construction. Grow food, preserve food, build things, create value, help others, build networks, trust relationships, community. When institutions fail, pay attention. Transition happening now. Watch for these milestones. Dollar reserve share below 50%. Acceleration intensifies. Oil trades primarily in Yuan. Petrodollar finished. Banks offer digital Yuan accounts. Transformation complete. These aren't coming decades away. Current trajectory puts them within 5 to 10 years. Part 5. The timeline. How fast does this happen? History provides guidance. British pound lost reserve status over 50 years, 1920-1970. But that was the pre-digital world. Dollar entered crisis around 2001 when reserve share peaked. We're 24 years in. Acceleration visible. China didn't need 50 years. Achieved central bank status in 10. Digital currency infrastructure compresses time frames. Decisions that took years now take months. Information spreads instantly. Capital moves instantly. Central bank coordination happens in real time. Conservative estimate, 5 to 10 years until transformation materially accelerates beyond current trajectory. Aggressive scenario, 2 to 3 years if geopolitical shock accelerates diversification. You have time to prepare, not infinite time, not decades, years. Probably less than a decade before this becomes undeniable to mainstream financial media. Conclusion: the choice in front of you. Every person in Weimar Germany had a choice in 1922. Hold marks or buy real things. Most held marks, lost everything. Every person in Britain during the 1920s had a choice. Trust the pound or diversify. Most trusted the pound. Savings evaporated over 50 years. Every person in Argentina during the peso crisis had a choice: hold paper or hold assets. Most held paper. Destroyed. You have the same choice right now. In December 2025, the pattern is clear. The stage is visible. The outcome predictable. Will you act on what you know? Or will you be the next generation learning this lesson the hard way? The clock is running. The pattern doesn't wait. Nobody's coming to save you. Only question is whether you'll save yourself. Subscribe. Follow. Prepare yourself for what comes next. Because revelation isn't coming. It's already here.